Good morning, everybody. I'm happy to be here today to present to you about community association lending. A little bit about me. Can we put up the first slide on the cover slide? I am a shareholder at the law firm of Becker, and I've been here for about 17 years, 10 of which I've done a lot of community association lending, representing condominiums, homeowners associations, and cooperatives with regard to obtaining loans from the various banks in our area. The smallest loan I've done was approximately $34,000, and the largest loan I've ever worked on was about $20 million. And one of the things that I did note recently as I was doing a multi-million-dollar loan and a smaller loan from the same bank with the same attorney at the bank was that those loan documents were virtually identical except for the value of the loan. So that's a little bit about me. I'm one of a group of attorneys at Becker that does loans and works on loans for community associations. Now I'd like to know just a little bit about who's out there. So can we go to the next slide, Laura? And I'm going to ask Laura to put up a poll question, because now you know a little bit about me, and I'd like for you, there's about 610 people out there, to just lean in and click one of the boxes and tell me who you are out there. Because later I'm also going to be asking a substantive question. So this is kind of the practice question. So can everybody just kind of lean in and click and let me know, are you a board member, an officer, a manager, a bank loan officer, an attorney, or a unit owner? So just click it with your mouse, move your mouse over it and click it. And as soon as we get a sufficient number of people who have answered, Laura, will you show the answers so that we know who's out there in our webinar today? So it looks like we have predominantly the board members and officers out there, as well as some managers. So that's good. At least I know who I'm talking to, because I did get a lot of questions from associations, and I just want to make sure that we're really targeting this seminar the right way. So let's go on to the next slide and talk about borrowing specifically. So one of the things that is very important as you get started is to know what you're really looking for as a product from the bank. Are you looking to take out a loan, or are you looking to take out a line of credit? And there is a difference between the two. For a loan, you might have, for example, a roof that you're working on that might cost you $2 million to put on a new roof. You're going to take out a loan. The bank is going to, every time you take out, have a contractor give you a bill, you're going to send it to the bank. The bank is going to write a check to pay that contractor off. And you're going to get most of that money almost immediately as that project is underway. If it's a line of credit, you might not have any issue that you need money for today, but you're taking it out sort of as a contingency so that you have a pool of money, so you have it as a go-to. So for example, if we, God forbid, got hit by a hurricane during hurricane season and you don't have enough reserves to pay for a new roof, you might have a contingency line of credit out there. The difference between a loan and a line of credit is that in a lot of line of credits, while it may be revolving, you have to, when you borrow it, you have to pay it down at the end of each year and have sort of a 30-day window. A lot of banks will require a 30-day window when you have a zero balance. Now, there are other products out there that I've heard of, I've worked on. For example, a line of credit that converts to a term loan. So you might borrow to pay for something, but it's such a large amount that you don't want to have to pay it down at the end of the year, so it will convert over to a term loan. So you have to understand when you're beginning the process what you're actually looking for, because only then can your attorney and the banks help you. So as we get past that, you understand what you want, the question really becomes, can we borrow? So some associations skip this question. You really have to check your governing documents, the declaration, the articles, and the bylaws, because the statute in 617-0302 provides that a not-for-profit corporation which almost all condominiums, co-ops, and HOAs are not-for-profit corporations, have the ability to borrow money unless their bylaws or articles say something to the contrary. So we would check all of your documents to ensure that you have the correct ability to borrow. Some documents, especially some older documents, have thresholds. For example, the board may borrow money, but only up to $250,000. The board may borrow money, but only for maintenance and repair. If it's capital improvements, then it would require a vote of the membership. So if you skip this step, which I have seen clients do, then you might be in a situation where two of my clients were. So I had one situation where the board obviously came to us at the 12th hour. They'd skipped all the steps we're going to go over. They did it themselves. They sent me minutes from their meeting and they said, we need a letter called an opinion of counsel letter, which we'll talk about a little bit later. And we need you to do that like today. And I looked at their documents and I said, well, where is the membership meeting minutes? Where are they? And they said, we didn't take a vote of the membership. Well, I told them, I was like, I'm very sorry, but I can't do an opinion of counsel letter unless we first do that membership meeting. So we needed to get an extension for the loan closing for at least the 14 days. That's the minimum statutory requirement to have the membership meeting. In another case, the association thought they had it correct. They actually did the membership meeting to get the loan approved because membership approval was required. Unfortunately, when they sent me the minutes, it didn't match the proxies that I reviewed. It came up short, so they had to do it again. And fortunately, again, this bank also kept their rate lock and allowed them to have the extra time. There is one bank out there, and it's actually on one of the banks that we would recommend to clients, but they have a very interesting way of doing things where they will say that your rate is locked, for example, through September 12th, but you don't have to close the loan till November 1st. If you miss the deadline for the rate lock, you could still have the loan, but we have the ability to increase your rates. So that's only one particular bank. Most banks will actually allow you to have a little extension if there's a very good reason to do that. Next slide, please. So one of the things to also consider, or the group of things to consider, is what are the impacts on the unit owners? I represent a lot of small condominiums where there's only 24 units. And they have to be careful when they borrow. They can borrow, assuming everything in the previous slide, we looked at their documents and they got the proper votes. The problem really becomes because these condominiums, the unit owners are on fixed incomes, can the unit owners actually pay back the loan based on the amount of assessments that they have the ability to get from the unit owners? So obviously, if you have 24 units where everybody's on fixed incomes, you have to think about your strategies on borrowing. If the 24 unit owners are all millionaires and the units sell for $5 million each, you might have a different type of loan borrowing ability than the ones on fixed incomes. You never want to overtax the membership because the association has to be able to make those loan payments every month. So sometimes if you have a repair and you know it's coming up in the future, just like with the new condo laws that are coming up and the associations are going to have engineers review their condominium property, and there might be some significant work that needs to be done. Now may be the time to start putting money away or getting a special assessment underneath a loan so that the amount you have to borrow might be less in the future. Next slide. So one of the things you want to be very, very careful with is you don't want to have any guarantors to your loan. And you might say, well, who would be a guarantor to your loan? Well, the answer is in a condominium setting or a homeowners association setting or cooperative setting, the answer is nobody. However, there is a set of documents that banks oftentimes try to sell to their clients as a low-cost alternative to attorney-prepared documents, and they're called Laser Pro documents. And the problem with Laser Pro documents is they were never designed, they were never geared towards community association lending. They speak more to the person who might be building a convenience store or has inventory that they can use as collateral. Those types of documents will oftentimes speak to the fact that the person signing the loan documents is one of the borrowers, and it will talk about joint and several liability with the, plus all your heirs and beneficiaries. So while under general corporate law, the signatory to a loan document should not be responsible in this type of a setting where it's a not-for-profit corporation and you're signing for and on behalf of the association, you don't want to accidentally sign a set of documents which changes that dynamic or even implies that it changes that dynamic. The Supreme Court in the state of Florida has said that when you sign a document, when you sign a contract, you are supposed to know what you're signing. It's not an excuse to say you don't know what you're signing. So let me give you an example. I had a condominium come to me and they said, Mark, we want to use Laser Pro documents. It's only going to cost us a few $100s. We don't want to spend $3,000 or $4,000 on attorney prepared documents. I was like, okay, it's not what I recommend, but I will give you a review. I will review this for you. When I reviewed it for them, they were like, absolutely no way we're going to sign that, especially since the bank said that they were not able to revise the Laser Pro documents because these are attorney prepared and they're in the computer and loan officers are not attorneys. So they went to another bank and against advice, they had them prepare another set of Laser Pro documents, which were very, very similar to the first set. So after 2 sets and 2 reviews of Laser Pro documents, they actually went and had attorney prepared documents, and then suddenly the loan closed very quickly. That became a very expensive undertaking for them because had they gone to attorney prepared documents first, they would have saved us having to do 3 reviews of 3 sets of documents. So I know that a lot of banks, even the banks on our list of recommended banks, will oftentimes suggest using Laser Pro for loans under a certain amount. Sometimes it's 3 million, sometimes it's 1 million. You should really have a discussion with your attorney, whoever he or she is, about this before going in that direction. Next slide, Laura, please. So when you take out a loan, you are giving to the bank collateral for the loan. The bank will record that collateral in something called the Florida Secured Transaction Registry. It is online. You don't need a password for it. It is something that you can very easily look at on your own. And the reason I suggest looking at it on your own is a lot of times clients will come to me and say, Mark, we don't have any outstanding loans with any banks at this time. We're good to go for the new loan. I'm like, okay, but I checked the Florida Secured Transaction Registry and I see that there actually is a loan outstanding with XYZ Bank. At least the registry reflects that there's a loan out there and that there is a lien on the collateral. What has happened is that the former bank did not file a notice of termination at the time that you paid off the loan. And I find that the banks are quick to file the notice of lien in the registry, but they're very slow when it comes to filing the notice of termination. So what you need to do is you need to get started as soon as possible contacting that prior bank, because your new loan may or may not close while that outstanding lien is still present, because the bank wants a first priority lien on your new loan. Sometimes banks will be generous and they'll say, while we're working on getting the notice of termination filed, at least let's get a letter from the bank that says that the prior loan was paid off. But this is something that If you've already paid off a loan and you're not even thinking yet of getting a new loan, make sure that the prior bank files a notice of termination so that it becomes a non-issue in the future. Next slide. So collateral. Collateral is one of the biggest things when it comes to association lending for a variety of circumstances. It's also sometimes the issue that we see most and have the most debates with attorneys from out-of-state banks who don't understand Florida law. So the issue that we're going to discuss, the issues we're going to discuss are what is collateral, when will it be used, and what cannot be used as collateral in a condominium loan. So let's go to the next slide and talk about exactly what collateral is. Collateral is something pledged as security for repayment of a loan to be forfeited in the event that there is a default. So go to the next slide, please. So when will it be used? It'll be used during the occurrence of an event of default. We have to make sure that your loan documents provide a cure period. This is something that if you're working with an attorney who's very experienced in doing loans, we're automatically going to be looking for that and making sure that you have some sort of cure period. Some of the raw loan documents will have no cure period. You default, you're done. They might accelerate your loan. They might exact whatever penalties are involved. Always try to have some sort of cure period. What we've done is we've gotten cure periods from as short as 10 business days to as long as 60 days for issues that involve having to go to court in order to be able to resolve something or cure an issue, because the banks don't really want to default you. We had a bank one time where there was a default from one of our clients, and what had happened was some loans have actually a ratio that they want you to maintain between the money coming in and the money coming out, and they'll have a very complicated formula that they'll put into their loan documents. Not all banks will do this, but a couple of them that we work with do. And what had happened is, even though we had the CPA for the association review the formula beforehand, somehow the math didn't work out right and there was a default. Now the bank, basically, there was a cure period and they said, look, we're going to discuss with the CPA and we're going to rewrite the verbiage on that section and do a modification of the loan because we don't want to default the loan. Banks don't really make a lot of money when they start defaulting on clients and suing clients. It's bad for business, and they don't make a lot of money when they do that. So most of the times, banks will try to give you a cure period, but it's better if it's written into the loan documents. Now, obviously, what we're going to do is we're going to be covering some of the general things. Most loan documents are going to be between 30 and 60 pages. We're really only covering the basics, and we want you to be able to walk away today with an understanding of the basics. So now let's go to the next slide. And what I'd like Laura to do is put up the next poll question. What is your understanding of collateral? What can be used as collateral for a loan in a condominium? The condominium building, reserves, insurance proceeds in the aftermath of a casualty, all of the above, none of the above. So go ahead and let's see what your understanding is for collateral in this type of situation. And the collateral is very similar in HOAs and cooperatives as well. So go ahead and lean in again. Give me an answer of what you think it would be. I used to have Jeopardy music that went with this segment, but unfortunately that didn't play very well where the computer's set up today. Laura, as soon as you see that we have a significant number of responses, go ahead and put it up on the screen. So the question was, what can be used as collateral for the loan in a condominium? The correct answer, which only 18% of you got, was none of the above. So for the 51% that put all of the above, let's go to the next slide and let's start talking about why those various components cannot be used as collateral. What cannot be collateral in a loan for a condominium? Reserves. The reserves in a condominium are kind of sacred. Pursuant to 718.112, the reserves and any interest thereon may only be used for the purposes for which they were allocated. Further, with the advent of the new law, SB 4D, which is coming up, you're not going to be able to use certain reserves for any other purposes, even with a membership loan. So when we talk about reserves, sometimes we'll have an argument from the bank's counsel, and they'll say, well, we should be able to have reserves. There's reserves for the roof, and what are they using the loan documents for? The roof. So why can't we use those reserves? Well, a bank loan is not really just about the principal. A bank loan has interest. A bank loan has fees. A bank loan might have late payments. A bank loan might have other charges. So the reserves were not intended to be collateral for a loan, so they cannot be collateral for the loan. The banks that we work with these days that are Florida-based banks will send us their documents, and it will specifically say that the reserves exclude reserve funds and accounts set aside for reserves. The next one is special assessments for purposes other than repayment of the loan. Now, under 718.116 subsection 10, it says that the special assessments can only be used for the purposes for which they were levied. One of the questions that came in from you from the registrants was, can we change the purpose? So absolutely. So in the case like this, what I always recommend is if you have a special assessment for a purpose other than repayment of the loan, that the board hold a meeting with the same 14-day notice or longer period if required by your documents, and repurpose the special assessment to include the tag and to repay the loan from XYZ Bank in the amount of. So then the purposes then become renewed, and then you would send a notice to all of your owners to let them know that you've done that. Most loan documents will say these days from the banks that we would recommend that special assessments for purposes other than repayment of the loan would not be permitted to be used as collateral. Now, the third one is insurance proceeds. Now, you're not going to find this in your statutes. But if you look at your declarations, you're going to say, it's going to say something to the effect of the insurance proceeds are obtained by the association as the agent for the unit owner and for their mortgagees. So what happens if there's a fire in your building after you've taken out the loan, then later on there's a fire in your building and the bank is the lost payee and they get all of those funds. Now the mortgagee is saying, well, one of the units that was burned is our unit, the one that we have our mortgage on. We want those proceeds. They're supposed to be signed over to us. Association, you obtain those for our benefit as well as for the unit owner's benefit. The last thing you want to do is say, oops, we let the bank that we have our loan with take all of those proceeds. That's when the association might get sued by the mortgagee for the unit owner, because the declaration is considered a contract under Florida law, and courts look at it that way. And it's a contract that predates and pre-exists the bank loan that the association has signed for. So we have to be very, very careful when a bank loan calls for insurance proceeds, because we don't want to get the association into that type of scenario. Now, number 4 is condominium property. And one of the questions that came up today that I received said, could we mortgage the condominium property and use the condominium property as collateral for the loan? And the answer is absolutely not. Why can't you use the condominium property, the building itself, your swimming pool, your clubhouse, as collateral for the loan? Well, because anything outside of the unit is considered the common elements. Who owns those common elements? It's not the association. The condominiums don't own the common elements. Each unit owner owns it in its undivided share. Okay, so you'll find those shares in your condominium declaration. So you can't mortgage what you don't own. Now, in cooperatives and in HOAs, the scenario might be a little different, but we would have to carefully review your governing documents before we could make comment on that. So that's not something I can give you a general assessment of based on statutory provisions. So we want to be very careful. And what will happen is sometimes if it's an outside bank, so a bank that's not from a Florida bank, the attorney will draft it and they'll put words like mortgage in there. They'll put loss payee for insurance. They'll put that they want to get all reserves and special assessments. Now, I will tell you that even the banks on our lists that we would give to an association might send you their initial commitment letter, and it'll say that we get a first priority collateral on the reserves and special assessments. They will, after being nudged a little bit, they will change that to remove all of these things. Now, one of the questions that I did receive are, when we're doing a loan and we're looking at these things as board members or as managers, what are some of the red flags that we may come across? And I will tell you that these 4 issues on the screen, if you see them in your discussion with the bank, if you see them in your commitment letter, if you see them in your information that comes to you from the bank, those are the red flags. The bank has to agree at the very beginning to remove these before you pay any commitment fee to the bank. Next slide. So what are the banks looking for? I listened to a very good podcast from my partner, Donna DiMaggio Berger. She has a podcast called Take It to the Board. You can find it at takeittotheboard.com, where she interviewed a bank loan officer who does a lot of association lending, and they are actually on the list of the banks that we recommend. I encourage you, if you're thinking about lending and you want to hear this type of discussion, but from the other side, from the bank's perspective, that you go to Donna's podcast and listen to it. It is online. It's not password protected or anything. You're more than welcome to listen to it. What are banks looking at? Here's just a little synopsis of what was discussed. The banks will look at loan amount versus the number of units and the valuation of the units. Banks do not take units as collateral. What will happen, though, is if the association stops paying on its loan after all the cure periods have expired, the banks will hire a receiver to take charge of everything the board is doing. So any unit owner who isn't paying their assessments, the receiver will immediately do what the association board probably should have done, and they will put them in collections and they will file the statutory foreclosure procedures. That's how the banks will get their money back if the association doesn't pay back the loan. They're going to look at AR over 90 days. Now, some banks are actually going to put that right into the loan documents. It'll say that it becomes an event of default if X percentage of your units begin to have an AR over 90 days. So you have to monitor that. Sometimes it's not in the loan documents, but it's part of the application process. Why is that? If you have 24 units and 13 of them have an AR over 90 days, meaning they're not going to pay anything to the association for whatever reason. I know in 2008, there were some scenarios where one person owned a majority of the units and walked away from them. I mean, you could have that happen. Well, how is the bank going to ever get its money back if too high of the number, there's too many units with a significant AR. They're going to look at insurance. It's not so much that they are looking to take the insurance from the perspective of being a lost payee, but if something happens to your building, there's a hurricane that causes damage, there's a fire, a flood, they want to make sure that you have the ability to restore the building, get the unit owners back in there so to make sure that that income stream, because that's all they have as collateral, is all of your income except for those things that we've removed in the prior slide, right? So every dollar you receive, whether it's from the unit owners in your special assessment that's for repayment of the loan, it's for your regular assessments for your operating budget. If you have a rooftop antenna that's bringing in a monthly income, that's that income source. But if there's damage to the building where any of that income stops, they want to make sure you have insurance to be able to deal with it. Litigation. Most banks are okay if somebody is suing you, as long as it's not something that if you lose, it will be financially catastrophic. However, if the litigation is about something like your right and ability to be able to obtain the loan, sometimes the bank might want to hit a pause button to really investigate what that particular situation is all about. And the banks also want to make sure that what you're borrowing makes sense in your particular situation. So again, if you want to hear an hour-long or 45-minute-long discussion with a bank loan officer that's done a lot of lending in this market, go ahead and listen to that podcast, and they'll really flesh out these particular points for you. Next slide. Florida law. Now, this may seem like a small thing, but I've had a number of situations where either a management company finds a bank that is not a Florida bank, or a president of an association has a good relationship with a bank in another state, and he decides that that's the bank that he wants the association to also use. While it's not impossible to use these banks, there are some things that are problematic. Anecdote that still to this day, it was probably about 8 years ago, I had an association insist that they were getting the best rate from a California bank. They wanted me to review the loan documents. There must have been 10 instances where the California statutes were peppered throughout the actual loan documents. And it said that if there was a dispute with regard to any issue, that it had to be done in Sacramento, California. It took a considerable amount of effort. It took perhaps 2 months to get that loan rewritten so that it rang true with the Florida laws, and that the choice of law was Florida law if there was a dispute, and that the venue would be in the county where the property, the condominium property, was located. So you really want to be careful with what these out-of-state banks will or won't do. I had another situation with an Arkansas bank where I had about 2 weeks of back and forth discussion with their attorney, who was not a Florida-based attorney, about the collateral, the things that I just educated you on. It was like I had to educate them and teach them Florida law before they would agree to change their loan documents to make sure that it met the conditions and requirements of Florida law. So that's another red flag when you're dealing, especially with out-of-state banks. It's not to say that you can't. It's not to say that the banks are good or bad. We're not making judgments like that. It's just to say what the loan documents will say. Because let me tell you, a lot of these loan documents can become very problematic. They can be 60 pages long, and they can be filled with things that don't match Florida law. Next slide, please, Laura. So the first thing you have to do is decide on the bank. Now, I know a lot of management companies try to do this for you, and one question that I received today was, are we breaching our fiduciary duty as a board if we use the bank that our management company recommends without looking for other banks? And the answer is no, you're not breaching your fiduciary duty. You're obtaining a loan to do the things you need to do. However, you might be selling yourself short because there are a lot of banks out there that they do so much association lending that they're much easier to work with from the point of view of a condominium cooperative or HOA. So by all means, you can do that. But recently, I would say within the last 2 or 3 months, I had 2 situations where a manager recommended a bank that I guess the management company worked with or dealt with. And in both of those scenarios, the association, after looking at the term sheet or the commitment letter, didn't move forward with it because the bank really dug its heels in on it, the terms and conditions. They didn't do a lot of association lending, and it became a problem because it caused a significant delay because now the associations both had to start over again with discussions with new banks. Consider the type of loan documents you're going to use. I can always tell immediately if it's not attorney prepared documents because I could see that the closing costs are only a couple $100 for loan documents instead of $3,000 or $4,000. I know that sounds like a lot, but if you want to have good documents prepared, it comes with a cost, and an association that can't afford it sometimes will add in $3,000 or $4,000 extra dollars to put into the loan to pay for the set of documents because, oh, by the way, if you didn't realize it, the association always pays the bank's attorney's fees. The bank pays nothing to get the loan for you, okay? See if the bank does a lot of lending. So even if it's a Florida bank, it doesn't mean that they know how to do association lending. Make sure that they have a track record for association lending because if they don't, their loan documents are going to be a mess. Speak with your attorney, and if he or she has done a significant amount of work in this area, they're going to be able to make the recommendations to you. And I always try to give at least 4 recommendations because it's not up to me to decide which bank you use, but it's up to me to give you banks that have good loan documents, are easy to work with, or easy to negotiate with. Because the dollars, whether it's $1 million for one bank or the other, I mean, those dollars are fungible. There's nothing special about that part of the product. The product that you need has to do with what are the repayment terms? What are the other issues that we come up with? I mean, we could literally do a 3-hour seminar on loan documents, but we're limited by our time today. Next slide. So one of the first steps you have to do is to fill out your loan application and be very, very honest. This is not the time to obfuscate. This is not the time to try to paint the pretty picture if it's not a pretty picture with your books and records. Failure to be honest, it is written in all the loan documents that any misrepresentation is a default. So you don't want to go into a set of loan documents, borrow the money, and then the bank suddenly discovers that they lent you the money on false pretenses. I have one association, they're a small 24-unit condominium. They have a lot of issues. They submitted a set of documents for underwriting to one bank that I've probably done 100 loans with, and that bank said no. They submitted it to another bank that we do a significant amount of loans with, and that bank said yes. So be 100% honest with your loan application. There are banks out there that will look at more than just the 4 corners of the application document. They'll actually try to figure out what's going on at the association to see if there's some way, somehow, that they can help. Don't just try to figure if we cover this up, then maybe we'll get a loan. That's the fastest way to hit a default. Next slide. So the next step in this entire process is the term sheet or the commitment letter. This is also the time when, if your documents, if you haven't already done so, now is the time, if you need a membership vote, to get a membership vote. So why would that be? Well, because when you submit your application, you're doing that generally without a fee. But when you sign the term sheet or commitment letter, you have to also provide a check to the bank, which is a non-refundable fee. Now, if it's a small loan, like the $34,000 loan that I did, that fee might only be a few $100s. But if it's a $20 million loan, that fee could be tens of thousands of dollars. So you don't want to be writing the check to the bank for your commitment fee without having first cleared the decks with any approval requirements for the loan that you have. Sometimes associations don't come to us until after they hit step 2. They'll come with a commitment letter that's already signed and the fee has been sent over. And then, oh, by the way, you didn't show it to us before signing, but you really can't do the loan with just board approval. So now we have to get membership approval. And if membership approval is not forthcoming, you might not be able to get those funds back that you paid to the bank. Okay. So another thing to remember is that the commitment letter you receive will only provide you the basic bullet points, not all of the terms and conditions of the loan. It is kind of like this presentation only covers the basic bullet points that you need to be aware of so you could see the red flags as board members or managers, but it doesn't cover the 60 pages of terms and conditions that we will read through. Yes, I read through it each time, no matter how many times I've seen a loan from that bank, because I will invariably find something new each time I read it. Next slide. After you get your commitment letter or term sheet signed and executed and sent back to the bank, the loan documents are going to be received and negotiated. Now, word of caution to the association: if the association gets the loan documents, sometimes they come directly to council, but sometimes they go directly to the association. The board, I have had it happen where the board will say, well, we're not sending it to council until we've reviewed these 60 pages or 40 pages. So they'll review it and then they'll give it to council. Say, I've had this happen where they give it to us on a Wednesday and said, oh, by the way, the loan says it has to close this Friday. Do it, review it. Now, generally for our clients, we will try to pull out all the stops if we can't get an extension, but don't do that to us because we may be working on a project for another client and might not be able to put everything aside to turn it around for you in 2 days. The best thing to do is if you get the loan documents on day 1, send it to council to look at simultaneously with the board, okay? The board first now has to make sure that you have the proper approval of the membership if required by your documents. A lot of governing documents do not require membership approval and the board can approve it. Now, what does that mean? That means that you have to approve it at a properly noticed board meeting where a quorum is present using the notice requirements of your bylaws. Let me give you an example of where that went off the rails. I have one association, they had a small loan, I think it was for a couple $100,000. There were 3 board members, they all attended the board meeting, they voted unanimously on the loan. I looked at the minutes they sent me and I said, you're gonna have to do this over because your bylaws require you to have 7 board members. So if you're required to have 7 board members, a quorum is 4, not 3. So they had to set up a separate board meeting to appoint one more person to the board, and then another board meeting where they actually then approved the loan documents all over again. Now, what I will do when I work on loans is I give you the notice and agenda, and I ask you to strictly follow that notice and agenda because I want to make sure that you are giving me all of the information I need to know for the opinion of counsel. Next slide, please. The opinion of counsel is issued by the association's attorney to the bank, as if the bank was the client. We have a duty of candor. We cannot obfuscate the truth because we're actually green lighting the process for the bank. Next slide, please. We're telling the bank that the association did everything it was supposed to do. We're assuring the bank that the loan will be binding upon the association and the borrower's entity. The borrower has the signatory authority. The signatories have been approved, that the entity is in good standing with the state of Florida. We're saying that there's no litigation except what we've told you about. And because of that letter, if we tell the bank that this loan is good to go, but it wasn't good to go, then there's potential liability for the firm. And that's why the opinion of counsel letter is charged based on the value of the loan. So for a $34,000 loan, we would charge less for the opinion of counsel than for a $20 million loan. And I will tell you that sometimes boards don't like it when we tell them they have to do a redo of the meeting or they have to do another members meeting, but we cannot issue an opinion of counsel letter when the association fudges something or has an error or there's a notice requirement issue, or like in this case that I gave you the scenario where there weren't enough board members on the board to actually approve the loan. So the opinion of counsel letter, while I would prefer the bank not even ask for it, it is something that comes at the very end of the process. I get a lot of boards that'll say, hey, Mark, we need a loan. And they're telling me this on day one before they've even received loan documents. And I will tell them that I can't give you that letter until I've actually reviewed the loan documents, because I need to see if there's some requirement in there that you have to meet before we can say that this is green light so that the bank can go forward. Next slide, please. The loan closing. So the banks, after we've gone through that entire process, will send a set of loan documents. Sometimes the loan officer will go to the association. Sometimes it'll get emailed over. Banks tend not to use DocuSign. You would think in 2022 they would. Most of the banks we work with require what they call wet signatures, meaning they're going to want the signatories to actually write their names and sign their names on the loan documents. In the off season, that means there's a lot of FedExing. It goes to one board member up north, he sends it to the next board member in another location, and then it gets sent back to the bank. And then we issue our opinion of counsel, the loan closes, and then it's funded. Next slide, please. So there's a difference between what the unit owner's concerns are versus the board's fiduciary duty. As condominiums have heard about SB4D, and just so you're aware, the firm is going to do a seminar much like this one, but only about SB4D. So that's why I'm not talking a lot about it today, because you're going to have a seminar coming up soon just about that issue. But that's going to be an expense that the association is going to have to do. The engineer is going to tell you have to do certain things, and you're going to say, yes, how soon do I have to do it? He's going to tell you, he or she will tell you how soon you have to do the work. And you have a fiduciary duty and responsibility, and you will do it as soon as the engineer tells you to do the work. You will not postpone work unless the engineer specifically puts in writing that this is not something that has to be done immediately. You will not ask your attorney that question, and you will not ask other board members what you want to do. You will always rely on that engineer as to what you have to do and when you have to do it. The unit owners sometimes don't want to spend money on things, but the board has a fiduciary responsibility to all the owners, not just the ones who don't want to do the work and spend the money. So especially if you have unilateral authority as a board to obtain a loan, you have to move forward. You cannot parse it out and put off necessary work. I have one association right now where the insurance company has called things a life safety issue. So the board came to me and says, Mark, do we have to do that? I said, I'm not an engineer. Get an engineer to see if he will verify that what the insurance company said is true. And if it is, you will fix it immediately. And that is what you have to do no matter how uncomfortable your unit owners are with the fact that you're obtaining a loan. Now, some loans can be paid off in 5 years, 10 years, 15 years. One of the questions was, what's a typical time frame for an association loan? There is no typical time frame. It's whatever works for you. If you have people in your building and they're all millionaires, maybe you have a 5-year loan. If you have people that are on fixed income, maybe you need a 15-year loan. While you're paying more interest, it might ease the burden on how much has to be paid back every month. You get the loan dollars so that you can pay the contractor immediately. The contractor is not going to wait 3 years for you to collect special assessments. They need to be paid when the work is finished so that they don't place a lien on your property. So that's why you get a loan, so you can upfront all those costs and then pay it off over time. Let's go to the next slide, please. So I put together a checklist, which is kind of a review of the things that we've discussed today. We talked about the idea of talking to your attorney from the beginning, not after you've signed documents. Talk to your attorney about what banks they might want to use or which direction you want to go and what type of loan. For example, are you taking a loan that's a term loan? Are you taking a line of credit? Are you taking a line of credit that can become a term loan? So there are some packages like that as well, so that if you borrow too much from your line of credit, you don't have to pay it down at the end of the year so that you have a zero balance for 30 days. You want to talk about what vote is required. Don't ever sign anything until you've checked with your attorney to be 100% certain that the board alone can do this, because if you do that, you might be exceeding your authority. Are your documents silent? Can you borrow? Which banks will you use? Select a bank and send whatever they require to underwriting, being 100% honest, hiding nothing. Bring everything out into the sunshine for the bank, because that will give you a good relationship with that bank. There was one time where an association, whether intentionally or by accident, hid something, and the bank didn't want anything to do with them. Obtain your term sheet or commitment letter and go over it with your attorney before you sign it, and don't show it to the attorney like the day it has to be turned into the bank. Sometimes I get it and there's one day left. I mean, the association board has sat on the term sheet for 2 or 3 weeks and they give it to you the day before it has to be in, and they say, you have to do this today. Revisions are made, you execute the loan documents, you approve the loan package, and then there's an opinion of counsel that's issued, loan closing, and the funds are available. Now, what I want to do now, go to the next slide. We have some questions that we received, and some of these questions are pretty good. I mean, some questions I absolutely can't answer, because one of the questions are, would we be crazy to take out a loan instead of special assessing? I don't know how to answer that question, so we're not going to do that particular one. Obviously, that's a discussion you would have with your attorney to determine what the best avenue would be between your regular assessments, your special assessments, and borrowing money, and whether you do it as a line of credit or a loan. Are there only certain types of loans HOAs are permitted to apply for? No, there aren't certain types of loans. You could pretty much borrow and take construction loans, term loans, other types of loans. As a treasurer, what are your liabilities for signing a loan document? The answer is none. I put in some of the loan documents, and some of the bank's attorneys will allow me to do that, a specific statement that says that the board of directors and the officers are not responsible for the loan documents or have any greater they have no greater liability than any of the unit owners would have to make repayments on the loan. Can a board take out a loan without a vote of the members? Again, that depends. Maybe they can. It's going to be based specifically on your governing documents. Can a community borrow money if they have money sitting in a contingency account for underestimated budget operations? The answer is yes, but those contingency funds will also become collateral for the loans as long as they're not part of the statutory reserves. Can a standby line of credit be arranged for hurricane deductibles? Absolutely. For hurricane deductibles, they can be used for insurance premiums, especially if they skyrocket. What I recommend if you get a term loan, if you get a line of credit, is to not limit it to just one thing. Talk about getting a term loan for business purposes and cash shortfalls, including but not limited to hurricane insurance deductibles, insurance premiums, and other emergency needs. Can loans be used to pay for SB4D needs, such as rebuilding, doing the things the engineer tells us to do? Absolutely. And we anticipate a lot of condominiums out there, once they really get into the SB4D reviews and figure out what they need for their building, there's going to be a lot of loans. Can owners pay the special assessment in one sum and not be included with the loan the board is applying for? So this really begs the question of whose loan is it? A loan is not the individual unit owner's loan. A loan is the association's loan. It is the association entering into the contract for the loan. The unit owners are not. The unit owners are paying off the special assessment. The unit owners are paying the regular assessments. They are not paying off the loan per se. Now, some of the loan documents will say that when you get a lump sum special assessment payment, that must be given to the bank to pay down the principal. But that is what the unit owners pay. It is not their loan. It is the association's loan. I had a question that also says, can the board not take out a loan if there's unit owners who can't pay their special assessment? And the answer is absolutely. You don't have to take out a loan. If you have 90% of your building that can pay the special assessment and 10% can't, you can tell that 10% that they have to go to the bank and take out individual loans on their own. That's something you may want to discuss with counsel as well. Do you have the names of lending institutions that work with condos? Yes, absolutely, we do, and I'm happy to discuss it with our clients offline. Can you do a majority the residents have to approve a loan? That again is based on your documents. Even if it says that borrowing must be approved by the unit owners, it's not necessarily going to be a majority. It might be a majority, but it might be some other number. Does this webinar report credits to the DBPR for CAM licensure? Not this particular session, because it's the first time we're doing it, and I don't believe we've actually sought out the CAM credits, but because of the high turnout, we may do that in the future. Let's see what other questions. Okay, so if your association takes out a loan and a few homeowners stop paying their assessments, do all the other unit owners have to pay back that loan? Well, it's the same if you asked the question differently and you said, if we have to pay our insurance, but 3 unit owners aren't paying their assessments, does that mean that the rest of the association has to pay for the insurance premiums or has to pay the electric bill? Yes, this is a contract the association has with the bank to repay it. The association has to be able to write a check every month to the bank. So if some unit owners aren't paying for it, that becomes problematic. You have to make sure that you have enough unit owners who are paying so that you can write the check to the bank. That's why in a previous slide, we talked about the number of ARs being very important to the bank. Laura, can you put up the last slide, please? So I want to thank you for attending today. It's been my pleasure. I really enjoy doing loans with community associations. If you have a need to have an attorney review loan documents, I'm here, our team is here, and we're always happy to help you with borrowing. My name again is Mark Friedman, and this has been a presentation from Becker on loans and borrowing. Thank you all. Have a great rest of your day.